Have you ever wondered how companies are valued? It's a question that sparks intrigue in the minds of many. Company valuation, you see, isn't just a game of numbers. It's an art that combines analytical acumen with a deep understanding of a company's potential. Picture this: two companies, each boasting a profit of $1 million. Are they of equal worth? Not necessarily. Their value hinges on a multitude of factors, from the stability of their earnings to their growth prospects, from the industry they operate in to the risks they face. Each of these elements plays a critical role in determining a company's value. The world of business deals in potential. It's about deciphering the promise a company holds for the future. It's about reading between the lines of balance sheets and income statements to understand the true worth of a company. And that, dear friends, is the fascinating world of company valuation. By the end of this video, you'll have a clear understanding of how company valuation works. To grasp the process of valuation, we first need to understand its basics. Valuation, as the name suggests, is the process of evaluating or determining the current worth of an asset or a company. This process is key in finance, and it's used in a wide array of situations, from deciding on investment opportunities to settling disputes and even in strategic management decisions. Valuation is like a health checkup for a company's financial well-being. It gives a snapshot of the company's current financial state, its potential for growth, and how it stacks up against competitors in the market. But how is this value determined? Well, it's not as simple as looking at the price tag on a product in a store. Valuation is influenced by a host of factors, some internal to the company and some external. Internally, the company's financial performance plays a significant role in its valuation. This includes its revenue, profits, cash flow, and assets, among other things. The better a company's financial performance, the higher its value tends to be. But financial performance isn't the only factor at play. The company's potential for future growth also significantly influences its value. A company with a strong, innovative product pipeline or a promising market strategy may have a high value, even if its current financials aren't stellar. Externally, market conditions can drastically affect a company's value. This includes the overall economic environment, industry trends, and even geopolitical events. For instance, a company operating in a booming industry might enjoy a high valuation, while one in a struggling market could see its value diminish. And let's not forget the role of perceptions and expectations. The market's perception of a company, its leadership, and its future prospects can significantly sway its value. In essence, valuation is a complex process that takes into account a myriad of factors, both tangible and intangible. It's a vital tool that helps investors, business owners, and even everyday consumers make informed decisions. Now that we've covered the basics, let's delve into the actual process of valuation. Valuation might seem complex, but it can be broken down into manageable steps. In the realm of finance, a comprehensive valuation process generally involves three main steps: analysis of financial statements, application of valuation techniques, and comparison with market competitors. Let's dive into each one of these steps and gain a better understanding of their significance. First up, we have the analysis of financial statements. This is the groundwork of valuation. Financial statements, including the balance sheet, income statement, and cash flow statement, are like the company's financial diary. They reveal a company's performance, financial health, and growth prospects. By scrutinizing these statements, we can unearth essential data such as revenues, expenses, assets, liabilities, and cash flows. These numbers tell a story about the company's profitability, liquidity, solvency, and overall financial stability. This step is vital because it provides the raw data that we'll need for the following steps. Next, we venture into the world of valuation techniques. One of the most popular methods is the discounted cash flow, or DCF. In essence, DCF is a way of determining a company's value based on its future cash flows. Imagine you're a fortune teller gazing into a crystal ball, except in this case, the crystal ball is a mathematical model, and the fortune you're trying to predict is the company's future cash flows. But instead of relying on tea leaves or tarot cards, you're using assumptions about the company's growth rate and required rate of return. The beauty of DCF is that it takes into account the time value of money, the concept that $1 today is worth more than $1 in the future. This step is crucial because it gives us an intrinsic value of the company based on its ability to generate cash in the future. Finally, we come to the comparison with market competitors. This step involves comparing the company's metrics and ratios, such as the price-to-earnings ratio, with those of its competitors. It's like sizing up athletes in a sports event. This comparison gives us a relative sense of the company's value. Is it overpriced or underpriced compared to similar companies in the market? This step is key because it provides context and perspective. It's one thing to know a company's value in isolation, but it's much more insightful to know its value in relation to its peers. So there you have it. From the careful study of financial statements to the application of valuation techniques like DCF, and finally, the comparison with market competitors, these steps provide a comprehensive view of a company's financial health and its position in the market. Valuation is not just about crunching numbers, it's about understanding a company's narrative, predicting its future, and making informed investment decisions. That's the art and science of valuation. There are numerous techniques used for valuation, each with its own pros and cons. Let's start with the discounted cash flow, or DCF, one of the most common and comprehensive methods used. It operates on the principle that a company's worth is the present value of its future cash flows. In simpler terms, it's the money you'd have in your pocket if you could collect all of the company's future profits today, adjusted for the time value of money. The DCF technique is effective when the company has predictable and stable cash flows, and when the business operates in a sector where similar companies can be compared. However, it requires making assumptions about long-term growth rates, which can be uncertain and subjective. Next up is the market multiples approach. This technique values a company by comparing it to similar companies in the market. The value is derived by multiplying the company's earnings or other financial metrics by the average multiples of comparable companies. This method is most effective in a mature industry with many comparable companies. However, it's not as suitable for unique companies or those in rapidly changing industries, as finding an appropriate comparable can be challenging. Finally, we have the net asset value method. This valuation technique is based on the company's net assets. It's the difference between the company's total assets and its total liabilities. This method is typically used when a company is in liquidation or bankruptcy, as it gives an estimate of what the company would be worth if all its assets were sold and all its debts were paid off. However, this method doesn't consider the company's future earning potential and might undervalue companies with high growth prospects. Choosing the right technique depends on the specific circumstances of the company being valued. It's like choosing the right tool from a toolbox. No single technique is perfect for all situations. Understanding the strengths and weaknesses of each method will help you make the best choice for your valuation. So, what should you remember about company valuation? We've journeyed through the intriguing world of company valuation. Let's take a moment to gather the pearls of wisdom we've collected along the way. Valuation, at its core, is the process of determining the economic worth of a company. It's like a financial mirror, reflecting the health of a business, its potential, its risks, and its rewards. It's a critical tool used by investors, business owners, and financial professionals to make informed decisions. The valuation process is a meticulous journey. It begins with understanding the business, its model, its industry, its competitors. This is followed by financial analysis, crunching numbers, interpreting financial statements, and forecasting future performance. The final step is applying valuation techniques to arrive at a value. And speaking of techniques, remember that there's no one-size-fits-all approach. The intrinsic value method focuses on the inherent worth of the business, based on its future earnings capacity. The relative value method compares the company to similar businesses in the market. The asset-based approach values the company based on the worth of its tangible and intangible assets. The key to remember here is that each technique has its strengths and weaknesses, and the most appropriate one depends on the specific circumstances of the business. Moreover, it's crucial to remember that valuation is both an art and a science. Yes, it involves analytical skills, mathematical models, and financial analysis, but it also requires business judgment, understanding of the market, and a dash of intuition. It's this combination of hard facts and soft skills that makes valuation a fascinating field. Understanding valuation is crucial, whether you're an investor, a business owner, or just someone interested in the business world. So, let's keep learning and growing together.